Hi, my name is Wilkinson, and this afternoon I'm talking about some concepts involving cash flow management for Gen X. This is another segment of our series regarding our Gen Xers, or the forgotten generation as I've called them. Particularly some of the key questions we've been receiving from our clients in this age group are about how do you actually manage cash flow and how do you do it in the most appropriate way to actually contain debt. I'd like to show you an example this afternoon. I'd like to start firstly by referring to two accounts that we often suggest, whether you have a loan or don't. We suggest that you have the first account, is in this case it's an offset account, but it could be a normal working bank account. And we suggest that all salaries from the household go towards this account. The second account we suggest that people have is an account which we've labelled discretionary expense account. The reason for this is we'd like to actually run the household as a business, and by that we mean that all cash flow goes into the first account, the hub or offset account, and by working out what your discretionary needs are, we actually work through the process of allocating on a weekly or fortnightly basis a sum of money to cover off your everyday working expenses, lunches, groceries, those sorts of things. But most of the savings occurs up here. We then allow and encourage the use of credit card, but in a controlled manner. We appreciate that credit cards are useful and that a lot of people use them to actually access the points. So what we'd suggest is that every credit card transaction you do essentially can occur, but payment will either occur from the hub or offset account to this account or from the discretionary expense account. Why so? Well, as you can see, the green line indicates that you are living below the line. So if an expense occurs on the credit card is a fixed or lumpy expense which is held up here, then it should be paid from this account. While down here, if it's a grocery or everyday expense item, then it should be paid from this account across to here. But what we're advocating is what we term the 7-day rule, whereby every 7 days, or at the very least 14 days, depending on your pay cycle, the credit card is reconciled and paid off completely. That way you're accessing your points, getting your points, but at the same time you're clearing your credit card debt, you're not running up any adverse expenses. So that's the process of cash flow, bringing the home mortgage into account here. We've added that in, the loan facility. What we're suggesting is the use of an offset account, or that same working account as we mentioned up here. And the reason for that is because an offset account has a special feature. Income going into this account immediately offsets the loan interest you pay on a daily basis. It doesn't earn interest. If you earn interest in this account, you have no offence, but you've got to actually pay tax on that income. While at the same time, it doesn't serve the purpose of paying down this bad or non-deductible debt. So an offset account is a perfect instrument which enables you to basically offset the loan facility, whilst at the same time, if you need cash, you can actually redraw it. But cash flow management is essential, hence why we've put in place this process. Well, this is a quick idea from Future Gen today. We hope you like it. If you've got some queries or questions, feel free to contact us.